Well, good morning, everybody. It's 10 o'clock, so I'm going to make a start. Good morning and welcome. This is the second DMH Dallard private client webinar that we've done, and I'm pleased to be joined today by Dominic Marr, who is a very bright and technically strong legal advisor in our team, just to embarrass him. Most of you know me, Camilla Bishop, partner. I've been advising on inheritance tax for some time. So we are today, this morning, going to run a much more informal webinar with the emphasis on your questions. So we will be taking your questions in priority over the other material that we've got to run through. So please do send in your questions using the question and answer button at the bottom of your screen, or it's at the bottom of mine. Dominic will be monitoring those questions and interrupting to put those to me, and we will both answer them if possible. We're not perfect, so if we can't answer them, we will follow up shortly. So what we've got to run through is a list of inheritance tax planning options for the UK. So this is sort of domestic inheritance tax planning, not cross-border. They're in no particular order, and Dominic and I will discuss each in turn. Now, I'm very mindful that there's been a lot in the press about the possible changes to CGT, going upwards, to come into line with an income tax, and also changes to the inheritance tax regime generally. We don't know when or how, but we are going to try and pick these points up as we run through. So if you do have any questions in relation to that, please do ask. Okay, so without wasting any further time, let's move on to our list. And as I said, in no particular order. So potentially exempt transfers, probably the simplest form of inheritance tax planning, say from actually asking your clients to spend the money or possibly give it to charity. So gifts. I think we take this for granted that in this country we're able to give away wealth tax-free, and it falls out of account after 7 years. There is an indication that the government are considering reducing this to 5 years and scrapping taper relief. So at the moment, the tax tapers after 3 years. So if taper relief is taken away, that obviously simplifies the regime.
I do, obviously, I just want to interject there and say, one of the most common queries I get from some of my clients is how the taper relief works. But the most common misconception is that you'll get taper relief after 3 years, no matter the size of the gift. And of course, that isn't the case. The gift has to be sufficiently large that it exceeds your nil rate band allowance at that time. And the reason why is because it's actually the tax that tapers and not the gift itself.
That's right. So really, from our point of view, if it changes from 7-year rule to 5-year rule without taper relief, really it doesn't make a huge amount of difference, because most of the gifts that we're looking at are below the nil rate band. So it's only for those very, very large gifts where taper relief has any effect at all. So yes, I agree. And the other point to note is that normal expenditure out of income is a relief that's very, very useful. There's no limit on it. And there is sort of, if like, an indication again that this may disappear. So should we be making gifts while we still can, and using the normal expenditure out of income while we still can? If a gift tax was introduced, and so every time you made a large gift, you paid tax there and then, it really would limit options for passing wealth down the generation tax-free. Okay, so moving on to option 2, putting the nil rate band amount into a lifetime trust every 7 years, which we can still do. There isn't any indication from the government that transfers into trust are going to change. So we're sort of assuming that the ability to put the nil rate band into trust every 7 years will stay. So this is very good planning for clients who have excess assets that they don't need the income from, so they can put these assets into trust but still control them for their children. Again, it's particularly useful where you've got assets that have got a gain, because when you do a transfer into trust, that's a taxable event for inheritance tax. So we're allowed to hold over the CGT. You can't hold over on an outright gift, but you can on a transfer into trust. I don't know what you think.
I was going to say, Camilla, this type of planning works particularly well where you've got a client who wants to contribute to a child's house purchase, for example. Several clients are thinking, oh, I want to make a loan to my children, but I'd like to sort of let them have a bit of control. Maybe they go on the title, for example, but I'm not really sure how to do this without getting into a mess. I think the simple thing to do would be to put that money in the trust so you have complete control, and then you make a loan out of that trust. And it works very well because immediately you make the gift to the trust, you've got it out of your estate, but you've still got that crucial control to protect your children.
And by making it via a loan, you've also got asset protection, haven't you, from your children's position. You know, if they, unfortunately became divorced, the loan could be called in, so asset protection as well. So yes, good idea. We had a question ahead of the session about what to do with assets that have a paper gain. And really, one of the few tools we have is CGT holdover relief. So we are, limited by the nil rate ban, but if you've got a married couple, you've got 650 that you can put into trust and defer the gain. So you might want to look at putting a rental property with a paper gain into a trust for your children and so on. Obviously, the rental income will follow the asset and will have to accumulate in the trust or be distributed to the beneficiaries of the trust. So that's one possible solution. Now, Dominic, I don't know what you feel about triggering the gain in light of the...
Well, I was going to say, with the changes that are, seem almost inevitable at this stage, the favourable rates that we've got at the moment might actually suggest that we should be looking to trigger those gains now. That if you bring it into line with income tax, then I think that you'll find that the people will end up paying more CGT in the long run, particularly as they're now threatening also to remove uplift on death.
Yeah, and really that's the big point, because at the moment we like to leave assets with a large paper gain in the estate because they benefit from uplift on death. But if that uplift is going to go, that's possibly the biggest change that's been suggested of all of them. There's no point in doing that. And while we've got the benefit of 20% or 28% on residential property, maybe we should be triggering that by putting assets into trust ahead of the budget potentially. There was
an interesting subtlety to that, though. They were saying that the uplift would only be removed where there was no inheritance tax charged. I couldn't see clearly what they really meant by that, but there was a suggestion perhaps that where IHT is payable, you won't pay CGT, there will be an uplift. Perhaps there's going to be an offsetting there. So it will be a planning exercise.
So we don't know quite what form it's going to take, and I think there's been two different suggestions, but you're right, certainly one of them was suggesting it would be IHT or CGT, but not both yet. So you either pay IHT and get the uplift, or if you don't pay IHT, you don't get the uplift, which possibly is one compromise that we might end up with.
I mean, the other more, I suppose, progressive bit of planning you could look at, for example, equity release on an asset that's pregnant with a gain, and then you try to use the money released to do some other planning to avoid triggering that CGT. I mean, that's already, we can do that now. We don't have to wait for the changes.
Yeah, and I think it's probably a good time to pick that point up, because equity release, while the rates are favourable, is certainly something we should be considering. And if you do have I suppose a specialist lender who's prepared to lend against a second property, you wouldn't be doing this for the main residence because there's no CGT anyway, so it tends to be a second property that's got a gain. If you can get a lender to give you a mortgage against that property and then you can gift the proceeds, you've got around that paper gain problem, haven't you?
Yeah, that's right.
In my experience, it just does take a little bit more work, and you need a client with a bit more appetite to deal with that.
That's right.
Yeah. Okay, well, let's move on to business relief. So really the point to make here is that if your clients have invested in business relievable portfolios, those assets are still in the estate, so they are still exposed to inheritance tax, and that relief hasn't yet been claimed. And I think a lot of clients misunderstand that. They think those assets are already exempt and it's in the bag. But if, you know, the government changed the rules, the wholly and mainly trading test, if they make that 80% trading to qualify, then, you know, a large majority of those investments are going to fail the test and won't get the relief. So I think we really need to think about what else we can do with these assets to, you know, ensure that they're not exposed to inheritance tax in the future. So I think if your clients don't need the income from the investments, or they don't need the ability to liquidate them, then why aren't we putting them into trust as well? What do you think, Dominic?
Oh, I agree. I mean, one of the things that people don't quite understand, because the R&RB legislation is still relatively new, but it's not to forget that the assets that might qualify for relief from inheritance tax will still actually contribute to your cumulative total for tapering of the residence nil rate band. You could end up with a horrible situation where you've got those assets that will push you over the £2 million threshold for tapering, and you lose your R&RB too. My view is that if possible, and the planning allows it, it should be better to try to claim those reliefs during a lifetime if you can.
I agree. And also another point to note about business relievable assets is that with the entrepreneurs relief being, you know, changed and radically restricted, there is an opportunity where people are exiting a business to put shares into trust ahead of the exit. And I've been doing a few of these recently. So you put, say, £1 million worth of shares into trust ahead of the exit, no entry charge because of business relief, but the cash proceeds are in trust and outside the estate. I mean, you still got the 7-year window, and you do need to think about the clawback rules, but that type of planning just wasn't favourable when we had such a large entrepreneurs relief allowance. So
that's
yeah,
right.
Yeah,
it seems that whenever you're making an exit like that, a trust is the way to go, because it does have favourable treatment on clawback.
Yes. So where it's a bit of a quirk in the legislation. If you make an outright gift of business relievable assets, it's not as favourable as a transfer into trust if that relief is lost in the future. So the business relievable assets no longer qualify. It's much better to have transferred them into trust. You basically protect the nil rate band.
That's right.
Worth remembering. Okay, so moving on to discounted gift trusts and loan trusts, two types of planning, which I know most of you will be very familiar with, so I'm just going to touch on them. Discounted gift trust. The thing that really stands out to me here is that you get an immediate benefit because of the discount. And it also enables your client to have an income, so you can carve out an income from the investment. These tend to be put into a discretionary trust, so the nil rate band is an issue, and you are limited by that, but very useful planning for clients who need income. The loan trust arrangement is a sort of longer term, slow burn bit of planning. So really it's just stopping the rot. So the loan itself, if you loan 300,000 to a trust, that loan is still in the estate, and it's only the gain on the loan that's in the trust. So really, again, suitable for clients that aren't overly wealthy and may need this money. They may need the loan back, but it does prevent the problem getting worse. So future growth is outside the estate. So it's a useful planning, but not massively effective immediately. Okay, so moving on to the next slide. Let's talk. I don't think we've had any questions yet. Please do send your questions in as and when. It doesn't have to be in relation to what we're talking about. It would be good to get some questions to answer. Family investment companies. So family investment companies, again, it's the long haul, it's the growth that's outside the estate. Same principle as a loan trust, but really on a bigger scale. So the loan in tends to be much larger, in the order of £1 million. It's best if it's cash. your clients loan that money in, and then the company invests the loan, and the growth on those investments is in the company and outside the estate. And the way that it's outside the estate is through the share classes. So the A shares would be the parent shares, the B shares would be the children's shares. The B shares would have very nominal value initially, but all of the capital growth is in the B shares. So you can see that it's effective planning for, again, stopping the rot and making sure the inheritance tax position doesn't get any worse.
As a lawyer, Camilla, we always think about protecting family from the things other than inheritance tax. And I note that we've got there that children's shares can also be put into a family trust. That's sort of taking advantage, isn't it, of the low value of the children's share, those B shares at the outset. And if we create the trust at that point, we've got some protection. So it might be good for parents of children who are under 18 or potentially vulnerable, or maybe even in a rocky marriage.
Yes, I agree. We've just had 2 questions in on the 14-year rule, Dom. Shall we cover this now? Because it is something that comes up from time to time.
It is, yeah. I suppose it's part of the rule about 7. Obviously, the 7-year rule on pets is fairly well understood, I think. So I won't go into detail about that. But as an overview, if you die within 7 years of making a gift that's outright, then it will be brought into account and knock off some of your nil rate band. If you then exceed the nil rate band at that point, then there will be inheritance tax charged on that gift. The 14-year rule, as it's sometimes called, doesn't actually mean that your gifts between the 7th and the 14th year will be chargeable. That's the most common misunderstanding. They think that it will bring into account those 7 and 14 year gifts on death. There will be no extra charge on gifts in the 7 to 14 year period. However, for those gifts that are chargeable within the 7 years before death, so year 0 to year 7, their charge could potentially be increased because they might have less nil rate band available to them. And the way that works is because in the 7 to 14 year period, you may have had a chargeable transfer which would have reduced the nil rate band. That, in plain English, means if your client created a trust between years 7 and 14, then you might need to bring that into account against pets that were made in years 0 to 7. Hopefully I haven't lost anyone there, but
yeah, I mean, it is a confusing point. I mean, just if I can try and put it as succinctly as possible. If you've got a failed pet in the last 7 years, you look at that failed pet, and when you're deciding what nil rate band is available to cover that failed pet, you look back a further 7 years. And if in that additional 7 years, so this can take you right back to 14 years if you're stretching it to the extreme. If there are any chargeable transfers, so transfers into trust, not pets, then that will reduce the available nil rate band. So it is possible to have a gift that was made 7 years ago and a chargeable transfer that was made nearly 14 years ago, to find that you've got a very small pet, failed pet, that's chargeable because you've got no nil rate band because of the earlier transfer into trust.
That's right.
So, and as a rule, you really want to leave 7 years, from transferring into trust before you make substantial pets. But sometimes it does make sense to make transfers into trust and then very quickly make the pets. So you just need to look at each case on its facts.
That's right, Camilla. People can get into a pickle when deciding whether to make their pets first or make their gifts to trust first. And obviously the situation will depend on the facts and what other gifts that client has made or what they're proposing to make. It's usually worth getting advice before you make those gifts, though, so that you can plan it accordingly.
Yeah, that's right. I mean, just put very simply on that point, if you want to do both, and you're going to do them both fairly close together, you would transfer into trust and then make the pets. so that your IHT at the 10-year anniversary isn't forever affected by a failed PET made just before. So you make the PETs afterwards. But say you put 325 into trust and then 6 years later you're thinking about making some big gifts, you might want to wait another year before you do that.
That's
so that
right.
if you die within 7 years, that old chargeable transfer isn't brought into account.
Yes.
Hopefully that's clear, but do let us know if it's not, and we can go back over that separately. So just one final point on family investment companies, because it's come up several times recently. Where I've had clients who are selling a business, it's worked really effectively to set up a family trust and a family investment company. So you use the family trust, you put some shares in ahead of the exit, so you get a nice pot of money there. Obviously, your clients can't have that back because of the rules on inheritance tax. But with the family investment company, they loan in their £1 million. They can have that money back in the future, tax-free, because it's capital repayment. And then obviously the gain is outside the estate. So the combination of the two can work really well, for your wealthier clients. Okay, let's move on to deeds of variation. Dom, do you want to cover this?
Yeah, this is something that I deal with an awful lot. Very often when I'm dealing with estates following the death of a client, I'll talk to the beneficiaries and see what their circumstances are. I think most people understand the general principle behind a deed of variation, where if you don't need the money, it would make inheritance tax sense to pass that down to, for example, another generation, simply because the deed of variation will make it as if the gift has come from the deceased and no additional tax will be paid. There'll be no gift by the original beneficiary. But that's not the only thing I like to use deeds of variation for. I'm quite keen on the idea of varying into a trust. And the reason why is because very often my clients aren't really sure whether they need that money or not, or they're not really that keen on giving it to a young beneficiary yet outright. And the trust, what the trust can do is, if you create it within the 2 years of death, you can then vary your inheritance to that trust, and it will have all the protective benefits of a trust that you've created, and you get to set the terms of that trust. Have a wide class of beneficiaries, give yourself all those powers that you need to control the money. But the beauty of it is that you can still be a beneficiary, because there's no gift with reservation on a deed of variation. This works particularly well if you vary a limited amount of your inheritance. So if you have inherited a very large sum of money, you could just vary part of it, perhaps less than £325,000, keep it under the nil rate band, and then you could, for example, loan out the money from the trust. It's very low admin, and there's no ongoing inheritance tax charges because you're still within that nil rate band. It makes sense because it's almost like having your cake and eating it. It's just so easy.
Yeah, agreed. It's rare that we get that opportunity, to have your cake and eat it. And I think when you're faced with a client that is inheriting, money that they don't necessarily need, it is a little bit of a no-brainer to vary there. We've had a question, Dom, about the residence nil rate band, specifically where first death has occurred and a nil rate band trust was in place. The attendee is asking what remedial planning action we can do to, I think, capture the residence nil rate band. It's a little bit difficult without the facts, but I'm assuming we may be considering, say, a lower value property where we may not have enough equity, qualifying residential interest to claim the RNRB. Do you have any thoughts there, Dom? Yeah.
Well, I suppose, are you saying that there's a nil rate band trust in the will, in the first will?
On first death. So 325 of the property has been, I suppose, potentially used up to satisfy that nil rate band trust. I mean, obviously we've got the transferable residence nil rate band. So if we've got enough equity in the survivor's share of the property, we can still claim the double residence nil rate band on second death. Or I suppose if we were within the 2-year window, we could vary the nil rate band trust, couldn't we, to make it
That's right.
a qualifying interest in possession.
Yeah.
So again, it's getting a bit technical. With the rules of the residence nil rate band mean that the qualifying residential interest that you need to claim that R&RB has to be either an outright interest or a life interest trust, effectively.
Yeah, that's right. A qualifying interest in possession. Yeah. So one that's been received on death. Yeah.
That's right. So I mean, there is remedial, solutions to that problem. We need to know what the value of the property is in that case. But you may look at rearranging the nil rate band trust. You may just look at claiming the second R&RB on second death, the transferable R&RB on second death. Potentially you could introduce a gift of the R&RB if you wanted to try and claim it on first death, couldn't you, Dom?
Yeah. I think that if we are talking about what we think we are, they might be on a sticky wicket there because there's just not enough equity in that property. So without enlarging their interest in property,
I mean, if we haven't got a problem with equity, you could claim the double R&RB on second death, couldn't you?
Yeah. Oh, definitely. Yeah.
Rate band. If you've got a problem with equity, you might look to restructure the nil rate band trust, but you'd have to be within the 2-year window. If the 2-year window is passed, you may find you haven't got enough equity to get the double R&RB, and you're just not going to be able to claim it. But probably in those circumstances, you're not going to have much of an inheritance tax problem anyway. Difficult to tell without the facts.
Yeah, definitely.
I do think on the R&RB there is a case to say if you don't use it, we might lose it, if they are looking to simplify the IHT regime. So there is an argument to say try and claim on first death if you can. It does tend to complicate the administration, but it is possible in most cases. Yeah.
Yes, that's right. Normally it's best, I find that if you're doing variations for other reasons, then yes, it can work well to try and claim it. But it's usually it's a rare circumstance where the complication involved warrants the claim. Yeah,
I mean you're only talking about 70,000 of inheritance tax for one residence nil rate band. A lot of money to most people. We've had another question on family investment companies and the revenue's attitude to them generally, which does come up. It's come up more recently in the OTS report, and it's been in the Financial Times did a piece on it a while back. So yes, it is a concern. I mean, it's no secret that the revenue don't like family investment companies, but I think they're a little bit stuck as to what to do about them because they are just a company, aren't they? It's a company that chooses to invest in whatever it wants to invest in. There's no rhyme or reason to what they invest in, and also they're not, avoiding tax. They pay their corporation tax. CGT would be paid on the shares if they're sold. So I do struggle to see what they will do about them, but obviously they can. We've seen it from their broad anti-avoidance legislation and the general terms in which they phrase things. So yes, they might get caught eventually, but as things stand, I think they are slightly stuck as to how to address them.
That's right. They're also very slow to deal with these types of things, and I appreciate there are reviews in the pipeline, but this seems like a very complicated area that they would have to deal with, and it would require a massive overhaul to jeopardize this type of planning.
Yeah, agreed. We've had another question on pensions. What's our views on pensions as a strategic planning tool, and are they an easier target than the direct changes to inheritance tax rules? Since the sort of pension freedoms were introduced, pension pots have become, a fantastic way to pass on wealth tax efficiently. Obviously, I think everybody feels that the tax relief that especially the higher rate taxpayers get from, pension contributions may change. You can't help seeing that as an area that they will target, so it may not be quite as favourable in the future as it's been now. But yes, I think in the scheme of in the whole family planning, the pension pot is just absolutely brilliant for passing on wealth tax free. I still think there's a time and a place for spousal bypass trusts. Perhaps where you've got a client who's terminally ill and you can get the whole pension pot out tax-free before they're 75. I still think that's worth considering. But certainly the pension pot tends to be, the pot that you don't touch if you're trying to mitigate inheritance tax.
Agreed.
Yeah. Whether they, who knows what the government are going to do. I think the inheritance tax changes are very political. Inheritance tax does not raise very much revenue. It never has, it probably never will. But I think they will look to, generate some favourable headlines from making changes to the inheritance tax regime.
We've got another question here, Camilla.
Yeah.
Where you do a deed of variation into a trust to use the nil rate ban for a series of rental properties, and as a result there's a split ownership, the remaining spouse and the trust, how does the ongoing administration work? So would all income expenses need to be split proportionately between the trust and the spouse and paid into 2 separate bank accounts?
Okay, so I'm just absorbing the facts there. So yes, the income will follow the underlying ownership. So if some of the property is in the nil rate ban trust and some of it's owned outright by the surviving spouse, there will be a split of the income, and it should reflect the percentage ownership. Otherwise, your trustees are in breach of their duties. Just for good trust administration, the trust should have its own bank account, so that money can be split and collected and distributed appropriately. Obviously, with the nil rate ban trust, the spouse is often, is always a beneficiary. So if the intention is that income goes to the spouse, well, that's totally possible using the trustees, discretionary powers over income.
One has to be very careful when creating those nil rate ban trusts about the distribution of income within the 2 years. I know you and I have spent many hours thinking and mulling over the best structure for that. The concern you want to avoid is inadvertently creating an interest in possession trust by mandating that income to the spouse.
I've done one of these very recently where we've used a rental property to satisfy the 325 gift to the trust. And in the 2-year period where we don't want to create an IPD, an immediate post-death interest, that income is sort of going to roll up and be distributed on an ad hoc basis. So we'll have to do tax returns for the first 2 years on the trust. And then after the 2-year window, we'll make a revocable, appointment of income to the surviving spouse so that we can mandate the income and the trust no longer has to do a tax return and the income automatically goes to the spouse. So we keep our relevant property trust by doing that. Yeah. Good. Okay, so I think we had finished talking about deeds of variation, and next on our list is gifts with lease back of the main residence. Always a favourite of mine. I always quote the scenario: you've got a £3 million estate, a £1 million house. If you give away the house, you can get below the 2 million overnight. You save 140,000 in tax because you've got 2 residence nil rate bans. And then if your donors live 7 years, you save another 400,000 in inheritance tax. So these are big numbers with, gifts with lease back. And, it's not rocket science. You give away the property and you pay market rent to stay in the property. You can have security of tenure through a lease for life. And at the moment, this is particularly favourable because of the stamp duty holiday. I'm actually doing one at the moment where we can do a 15-year lease and pay no stamp duty. So yeah, incredibly favourable between now and March if you've got clients that have got an appetite for this.
So I agree, Camilla, that's always been the one sticking point, is finding the money to pay either the market rent or the stamp duty that ensues. And with that stamp duty holiday, it makes perfect sense, really.
It does. It's not for every client. The ideal client is a client that wants to live out their life in the house they're in, so they're not planning to move. They've got, oodles of surplus wealth so that the market rent, doesn't really even scratch the surface. The market rent being quite tax neutral in my mind because you're saving inheritance tax on it, but your children are paying income tax on it. And that you've got a nice stable family, with no divorces on the horizon. So if you've got that kind of client, it's fantastic inheritance tax mitigation, but not for everyone.
No.
Okay, so moving on to what I call a 90-10 gift. And actually, the big stumbling block with a 90-10 gift is capital gains tax, because it is an outright gift. So if you've got a rental property and you give away 90% of the equity, you're triggering capital gains tax on that 90%. But it does enable you to keep the lion's share of the rent, because the revenue, except that joint owners of a property can agree between them how the rent is shared, as long as it's reported on their tax returns in that way. So really useful planning where you've got clients that want to keep their rental income. And actually with the CGT, likely to be on the up, triggering a bit of CGT is not necessarily a bad thing. So if you have got a client that can afford the CGT, or even some of the CGT, we could reduce the amount of the gift. It might be worth considering.
I do have a couple of clients who are using this tool to give progressively annual amounts of equity to their children to make use of their annual exemptions between gifts, making a gift over to spouse, and then they make a joint gift. Doesn't sound like much, but over a number of years, it's amazing how much can be transferred.
Yeah, I mean, what would worry me there is that, when is this change going to happen? We might only have, the 2021 tax year to use.
That's right.
You are right. If they don't introduce the CGT changes in the budget, we might get another tax year if we're lucky. Yeah. Shared occupancy gift. This is another one, it really has no downside if you have got a client who has an adult child living with them, because there's an exemption to the reservation of benefit rules. So you're able to give away a share of the main residence. It doesn't have to be the main residence, but it usually is, to an adult child, and you don't have to pay market rent. So shared occupation, shared enjoyment. It's still a pet, so you've still got all the 7-year rule and everything that goes with it, taper relief, etc. But again, you can get some big numbers here. So it's great for those clients who can't afford market rent, but just happen to have an adult child living with them.
I think that's the key, isn't it? That if there's any possibility or a good possibility that a child might move out in the future, this is one you've got to be really careful about, and they need to understand the limitations, because as soon as that child moves out, then we're back into gift with reservation territory. We
are, that's right. And you'd have to pay market rent immediately if that was the case. We've just had a question on the 90-10 gift. So presumably 90-10 works better for buy-to-let properties just being purchased from the outset from a CGT perspective. Yes, so exactly that point. If you've got an asset that doesn't have a gain, that's perfect for a 90-10 gift. So whether you're unlucky enough to have a property that hasn't gone up in value, or you've just purchased one. If you're just buying it, you might argue, well, why don't you just give the cash to the child instead? But it doesn't allow you the rent sharing arrangement, so there is some merit in it. Yeah. Okay, so nil rate ban trusts, not lifetime trusts this time, trusts in the will. Most lawyers always go on about nil rate ban trusts in the wills, and I'm sure some people wonder why, but really it does make sense to put one in. In my mind, if you've got a taxable estate, so as soon as a married couple's estate goes over $1 million, you should think about a nil rate ban trust. Because of the joint property discount, it does enable you to effectively increase that nil rate band on first death, and then get a discount on second death on the balance of the main residence. So for those that are just going over the 1 million mark, I think a nil rate band trust is really good. And for clients who are approaching the £2 million mark, a nil rate band trust is really good, because you get 325 out of the estate on first death. So you stop the survivor breaching the 2 million. So for those two reasons, it does no harm to put one in, and you can decide on first death whether it's worth keeping it or not. And we don't know what tax changes are going to happen. It can be wound up within 2 years, and it's as if it never existed. So if in doubt, put one in. Did you have anything to add on that, Tom?
I agree. I mean, it's just a no-brainer. As you say, the £1 million mark seems to be the golden sweet spot for me. because you just don't know what's going to happen. And so often clients never get round to updating their wills. And it's so often that a nil rate band trust has saved us on that first death. It really is a no-brainer to me.
Yeah, I agree. And in addition, if we think we're going to be stuck with 325, for the next 10 years, which I don't think it's ever going to go up. Any capital growth in the nil rate band trust also saves inheritance tax. So again, worth doing from I suppose from the perspective that the 325 is unlikely to increase in the foreseeable future.
Great.
So moving on to the last point on our list, the whole of life insurance, again, something I'm sure you're all very familiar with. I've put a comment, not really inheritance tax mitigation, which doesn't put it in a favourable light, but I mean, obviously it has huge merit and generates funds that wouldn't otherwise be available to go towards whatever might be needed. And paying inheritance tax is one of those huge bills that you get that the children are left with. So a whole of life policy, second death written into trust can be perfect. I think it really comes into its own if the premiums can be paid out of income, surplus income, so you get the normal expenditure out of income exemption. Because if the life policy is in a relevant property trust, a discretionary trust, those premium payments tend to be, and they usually are, chargeable transfers, unless it's a bare trust. So those can clock up, if you've got a substantial policy and you don't want to be hitting entry charges. So normal expenditure out of income, very useful in terms of a whole of life.
It does. It really takes the headache out of that normal expenditure out of income calculation as well, because you know where you stand. You've just got that regular gift, you've got the pattern of giving that you're looking to establish. It does work very well.
It does, yeah. I'll come back to the life insurance because I also wanted to say something about the importance of keeping the premiums going. But we've had a question.
Another question, yeah.
Yeah, on downsizing. I think this is in relation to the gift with lease back at the main residence. Well, that's what I'm assuming, but if it isn't, do let me know. So you may be wondering, if you give away your whole main residence, how can you claim the residence nil rate band? Because you've got no main residence to claim it against. Not that it has to be a main residence, it's only somewhere you've lived in, actually. That's what the legislation says. But the downsizing provisions allow you to claim the residence nil rate band even when you don't have a house, because as long as you had a house back in July 2015 that you lived in, that had enough equity, you can claim the residence nil rate band, providing equivalent assets to the value of the residence nil rate band passed to the direct descendants. So if you go back to my 3 million scenario, the house has been given away, they've still got 2 million left. So as long as 350 of the 2 million go to direct descendants, you can still claim the R&RB using downsizing. I think that was the question. If it's not, do put me straight.
Another question, Camilla.
Yeah.
When should a deed of variation be done, either before the application of a grant of probate or after?
Okay, I mean, the key date for deeds of variation is the 2-year deadline. So in some cases, there is a need to do the deed of variation very quickly. For example, if you want to claim the residence nil rate band, you need to do the deed of variation before you put in your inheritance tax return. So if it's tax driven and you don't want to pay the tax and then claim it back, you probably want to do it immediately or very quickly. If it's not quite so urgent, probably you'd get granted probate and then start to think about what rejigging you might want to do.
That's right. I mean, so it's an established rule that you can do a deed of variation before a grant of probate has been obtained.
That's right, yeah.
Another question, consider pilot trusts so that post-claim interest-free loans can be advanced to beneficiaries, which can then be deducted from the beneficiaries' taxable estates.
Do you follow that?
I think so. I think it is, presumably they're asking would a pilot trust or creation of pilot trust be beneficial if you can make interest-free loans out to beneficiaries, which are then deductible in their estates?
Yeah, so I suppose that's just sensible planning, isn't it? That you're almost doing intergenerational, aren't you? So you are not loading the beneficiaries' estates with assets. So it does two things. It's tax efficient and it offers asset protection as well from those beneficiaries situations, doesn't it?
That's right.
Yeah. I mean, I do quite like loans as opposed to outright distributions, because they are so flexible, aren't they? They can be pulled in at any point.
They've got so many uses, and people often think that the planning involved with pilot trusts, has been changed since the same day addition rules, which are complicated. But no, we still find that they've got many uses, not least, trying to claim business relief on the way in, on exit from of a business. You can create pilot trusts on separate days and try and make use of different nil rate bands for each of the trusts. That still works. Yeah,
so multiple pilot trusts, which that sort of planning was totally shut down by the same day additions. But if you've got business relief, you can create your transfers in on different days, so you avoid the same day addition rule. That's what you're saying, isn't it?
Yeah, that's right.
Going back to the question, I think in the situation of my terminally ill pension member who redirects the death benefit to a pilot trust, a spousal bypass trust, I agree, loans out to the spouse would be the perfect solution there, because the whole pension pot is then IHT free and passes to the children. So loans can be made to the spouse. So yeah, very tax efficient.
I see. Yeah, I see what they're saying.
I think that's what the question was aimed at.
I think that's what the question's aimed at. Yeah.
And we've got another question. Would you use a discretionary trust or absolute trust for a whole of life policy on joint life second death policy? Well, this really, yeah.
I was going to say, I think it depends on the circumstances, doesn't it?
Yeah, and the value. I think discretionary trust would always be my preference. I suppose for two reasons, because you're not loading anyone's estate. It's a relevant property trust, so it's got its own tax regime. But you do need to watch that entry charge and the 10-year charge. I've got a client who has a whole of life policy where the premiums are going up. I know these aren't very, they aren't sensible policies to take out now, but they're really beginning to leap up. She's nearly 90, I think, and we are approaching an entry charge based on the amount that's been paid, but there's no option but to keep going because they've paid so much already. And you think, well, if she lives to 100, this is going to get really bad. It's going to become mitigation rather than
benefit.
Yeah, it's just going to be, well, is it better to continue or stop? So yeah, tricky situations. But I think I'd always favour a discretionary trust, because an absolute trust or a bare trust is totally rigid, and you've effectively given that policy to an individual. And if that individual dies, divorce, or doesn't need the money, you're stuck. Yeah.
Another the deed of variation 2-year clock is from the date of death was notified. No, as I understand it, it's 2 years from date of death, full stop.
Yeah, and just to clarify that point, my understanding, Dom, you might disagree, is that the date of death is the last day that the deceased was alive. So the actual day of the second anniversary does count. Yeah.
Yeah.
Yeah. So if you, but I wouldn't push things right to the limit. Don't.
No, indeed.
Yeah. Good. Have we got another question? Looks like we have. It's quite a long question. You read that out, Dom. And
I'll read it out. Want to watch on death in service life cover benefit. I had a situation earlier this year where the mother took her own life and had in place a death in service plan for over 1 million. As a lifetime pilot trust had not been created during the mother's lifetime, the insurer was not prepared to split the claim proceeds between a trust for the children and advance funds to the surviving spouse as well. Instead, the surviving spouse had to receive the full claim into his taxable estate and then make a potentially exempt transfer or chargeable lifetime transfer for the children, and not ideal. So make a pilot trust.
Yeah, so I think this just highlights the fact that pilot trust planning is not dead, and it does have, a place. And where people have got, large lump sums, payable, whether it's death in service, life policies, pension, they should be carefully considering where this debt lump sum is going to go. Keeping nominations up to date, considering pilot trusts, all of these things need to be done as part of the overall planning.
Right.
I don't know if you had anything to add to that question.
I do. The pilot trusts are a convenient tool, and if it is sometimes difficult to predict when you might need them. So you can't just go around to every client saying, "Oh, make a pilot trust and let's go with it," because it almost seems like a redundant exercise if it's never used. But at the same time, if there is any possibility it might be necessary or needed, then I do think if you're doing any other kind of planning for them, it's such a simple exercise to create one. I do agree. It's better to make one than not to.
Good. I think we've answered all our questions, but if you've got any further questions, do put them in now. We've got a few minutes. I just very quickly say, I think at the moment there are really quite good opportunities to plan. We still have the ability to do large gifts. We can put assets into trust. We've got business relief that's very favourable. We can put those assets into trust. We can do gifts with lease back of the main residence, stamp duty free. But this isn't going to go on. I think we all know that the regime is going to get tougher, and probably starting from March and onwards, and it's only going to go in one direction. So if you've got clients that want to mitigate tax on their death, now or in the coming few months is a really good time to look at things. That's my thoughts. Dom, did you want to add anything there?
My only final thought is maybe to end on a note of optimism, which is, well, depending on which way you look at it, it seemed to be suggested that actually inheritance tax and capital gains tax were really marginal taxes. They're not where the Exchequer will be looking to plug the gap that's been created by the lockdowns. I think that they'll be looking at income tax more and other taxes rather than necessarily inheritance tax. Inheritance tax has always been a really tricky tax to get your head around, and they've stayed away from touching it because it is just so complicated. I would be amazed if it changes, radically in the near future.
Yeah, you've always thought that, haven't you? You always think they tie themselves up in knots and then do nothing, which is why we stuck with bits of legislation like the R&RB that are horrible, but they don't know how to change it once they put it in. So we just carries on. So we will see. Someone's asked if the session is recorded. Yes, it is being recorded, and it will be available on our website, but we'll send out a link in due course. The slides are obviously, Dom and I spent hours putting these together. So yeah, we're gonna be selling those off at £100 a pop. No, the slides will be available as well. But it is a nice succinct list of all the options that are available. So very useful, I think. Good. Any last questions from anyone?
Do feel free to send through any questions by email. Camilla and I would be more than happy to help. Yeah,
I mean, as always, most of you know how I work. Very happy for you to bounce questions off me. I see clients, as Dom does, on a no obligation basis, just so that we can explore, how we can help. We believe in adding value and charge for adding value. So if there's nothing to be done, we will say there's nothing to be done. So please do get in touch. And thank you very much for your time this morning. I hope that was useful. Good to hear all your questions. Thank you.
Thanks.
Yeah. Bye for now. Bye.